Good day everyone, I am Vaishnavi will be the first presenter for this presentation. Today our group will be presenting a financial performance analysis of two companies in the chemical industry. The purpose of this presentation is to evaluate the financial position, performance and efficiency of the selected companies using financial ratio analysis. We will focus on trend analysis and peer comparison to understand how the companies perform over time and relative to each other. Before we begin, I would like to introduce my group members. The second presenter will be Wali Erod, next Nitya Shri, daughter of Krishnamurti, then Nabil Ramdan bin Muhammad Tursina, and lastly Nadia bin Nurhamidi. Let's begin with the company's background. The first company is Petronas Chemical Group Berhad, one of the largest petrochemical producers in Malaysia and the region. PChem operates on a much larger scale and is involved in producing basic chemicals, fertilizers, and polymer for both domestic and international markets. The second company is Laschem Corporation Berhad, which is a Malaysian-based chemical distributor and manufacturer. Laschem mainly operates in specialty chemicals, industrial chemicals and related products serving industries such as manufacturing, construction and consumer goods. For this project, Petronas Chemical Group Berhad was selected as the leader company because of its strong market position, large asset base and industry influence. PChem serves as a suitable benchmark due to its financial strength, scale of operation, and role as an industry leader. Laschem Corporation Berhad was chosen as a Company A for trend analysis because it represents a mid-sized firm with visible changes in financial performance over time. This makes Laschem suitable for analyzing trends and comparing its performance against a market leader like PChem. Let's begin with the trend analysis of Laschem Corporation Berhad for the period from 2022 to 2024. First, I will discuss the liquidity position of Laschem Corporation Berhad. The current ratio shows that Laschem maintained a very strong liquidity position throughout the period. In 2022, the ratio was 4.96 and increased further to 5.11 in 2023. Indicating that the company had more than sufficient current asset to cover its short-term liabilities. However, in 2024, the ratio declined to 3.85. Despite this decrease, the ratio remains well above the benchmark of 1.0, which means Laschem is still financially capable of meeting its short-term obligations. The decline may be attributed to higher current liabilities arising from increased operational activities as well as lingering post-COVID-19 effects such as supply chain adjustment, rising costs, and changes in working capital requirements. Moving on the quick ratio, Laschem also demonstrates strong immediate liquidity. The ratio improved from 4.14 in 2022 to 4.33 in 2023, showing that even without relying on inventory, the company could comfortably meet its short-term commitments. In 2024, the ratio declined to 3.10, mainly due to high inventories and current liabilities. As I mentioned before, it might be due to COVID-19. Nevertheless, this level still reflects a strong short-term financial position. Next, I will explain Laschem's asset management efficiency. The inventory turnover ratio indicates how efficiently the company managed its inventory. In 2022, the ratio was high at 10.14 times, suggesting effective inventory movement. The ratio dropped to 8.13 times in 2023, indicating slower inventory turnover, possibly due to weaker demand or cautious inventory holding due to the COVID-19. However, in 2024, the ratio rebounded to 10.05 times, reflecting improvement in inventory management and stronger sales performance. For days sales outstanding, Lustchem experienced an increased trend from 51 days in 2022 to 62 days in 2023 and further to 69 days in 2024. This suggests that the company took a longer time to collect receivables from customers. The rising DSO indicates increasing pressure on working capital and highlights the needs for better credit control and collection efficiency. The fixed asset turnover ratio shows how efficiently fixed assets are used to generate sales. Lustchem record a strong ratio of 6.81 times in 2022, which declined to 5.40 times in 2023 due to lower sales and increase in fixed assets. In 2024, the ratio improved to 6.36 times, indicating better utilization of fixed assets and recovery in operational performance. Similarly, the total asset turnover ratio declined from 1.12 times in 2022 to 0.88 times in 2023, reflecting weaker asset efficiency. In 2024, the ratio improved slightly to 0.97 times, suggesting a gradual recovery in the company's ability to generate sales from its asset base. Lastly, I will discuss Lustchem's debt management position. The debt to total capital ratio remained low throughout the 3-year period, ranging from 8.01% to 11.69%. This indicates that Lustchem released more on equity financing than debt, reflecting a conservative and low-risk capital structure. Although leverage increased slightly in 2024, the overall debt level remains manageable. The times interest earned ratio further support this observation. Lustchem recorded a very high interest coverage ratio across all 3 years with values above 20 times. This shows that the company generates sufficient operating profit to cover its interest expenses comfortably, indicating strong debt servicing ability and low financial risk. In conclusion, Lustchem demonstrates strong liquidity, efficient asset utilization with some fluctuations, and a conservative debt structure. Overall, the company shows a financially stable and low solvency risks, providing a solid foundation for further analysis on profitability and market performance. Next, my group member will continue with the analysis on efficiency and profitability ratio. Thank you.
Thank you, Vaisnavi. Next, I will present the profitability ratio of Lustchem, where we analyze how effectively the company generates profit from its operation and asset over the past 3 years. Profitability ratio measures a firm's efficiency in generating profit from its available resources, and analysis of Lustchem's profitability from 2022 to 2024 indicate an overall improvement in operating performance despite some short-term fluctuations. Operating margins from 2022 to 2024, Lustchem demonstrated a steady improvement in operating margin, reflecting the enhanced operating efficiency. The margin increased from X.8% in 2022 to 9.23 in 2023, indicating better cost control despite challenging market conditions. In 2024, the operating margins rose rather to 10.37%, supported by the improved pricing strategy, effective cost management, and high operating leverage. Overall, these upward trends highlight Lustchem's ability to strengthen profitability from its more core operation over the 3 years periods. Profit margin, Lustchem profit margin show the consistent upward trends from 2022 to 2024, reflecting stronger bottom line performance. The margin increased from 6.39% in 2022 to 6.6% in 2023, demonstrating effective cost management despite softer market conditions. In 2024, the profit margin improved further to 7.0% 42% driven higher earning and enhanced operation efficiency. Overall, the result indicate Lachem increased ability to convert sales into net profits. Lachem's return on assets experienced some fluctuation over the period but remained at a healthy level. ROE stood at 7.15 in 2022, indicating effective utilization of assets. It declined to 5.88% in 2023 due to weaker profitability and a higher asset base. However, ROA rebounded to 7.18% in 2024, reflective improved earning and more efficiency asset utilization. Overall, the recovery in 2024 suggests improved asset efficiency following the temporary slowdown in 2023. From 2022 to 2024, Lachem return on equity showed moderate fluctuation but remained relatively strong. ROE was 10.01 in 2022, reflective effective use of shareholder funds. It declined to 8.16 2023 due to lower profitability. In 2024, ROE rebound to 10.46%, supported by higher net profit and improved operational performance. Overall, Lachem demonstrated a recovery in shareholder return after the temporary dip in 2023. Lachem basic earning power shows some fluctuations over 3 years period but remains strong overall. BEP declined from 9.93% in 2022 to 8.15% in 2023, reflecting slightly weaker operating performance. In 2024, BEP rebound to 10.04%, indicating improved earning relative to total asset. Compared to PChem's BEP of 3.25 in 24, Lachem demonstrated significantly strong ability to generate operating income from its asset base. The DuPont analysis showed that Lachem return on equity fluctuates during the period, declined from 8.91 in 2022 to 6.95 in 2023, mainly due to weaker asset utilization. Despite relatively stable profit margin in 2024, ROE rebounded to 8.51%, driven by improved profitability and better asset turnover throughout the period. Financial leverage remain moderate, indicate that changes in ROE were largely influenced by operating performance rather than increased reliance on debts. Next, trend analysis on market value ratio. This ratio is to evaluate the current share price of a publicly held firm stock, whether it is overpriced or underpriced. Let me look at the price per earning ratio. From 2022 to 2024, Lachem per earning ratio showed a notable fluctuation, reflecting changes in market expectation and earning performance. In 2022, the PE ratio stood at 12.53 times, indicate moderate investor confidence in the company earning potential. In 2023, the ratio increased to 14.87 times despite lower earnings, suggesting that investors maintain the positive expectation about Lachem's future recovery. However, in 2024, the PE ratio declined to 11.25 times as earnings improved, indicating that the stock became relatively more attractively valued. Overall, the trend suggests improving earnings support and more reasonable valuation in 2024. MB market price per book value per share from 2022 to 2024, Lakhem's market to book ratio declined gradually, indicate a more cautious market valuation. The ratio decreased from 1.12 times in 2022 to 1.03 times in 2023, reflecting weakening investor sentiments. In 2024, the ratio fell below 1.0 to 0.96 times, suggesting that company shares were trading slightly below book value, potentially indicating conservative market expectation or temporarily undervaluation despite stable financial performance. Next, enterprise value to earning before interest, taxes, depreciation, and amortization. From 2022 to 2024, Lachem EV per EBITDA ratio declined steadily from 9.61 times to 8.05 times. These downward trends indicate improved valuation efficiency, supported by stronger EBITDA growth in 2024 relative to enterprise value. Overall, the lower EBITDA suggests that Lachem become more attractively valued, reflecting improved operating performance and earning strength. Thank you.
Hi all, I'm going to explain about peer analysis. Peer analysis is a company's financial performance with similar companies in the same industry to evaluate the strengths and weaknesses. So compared to our companies which we have been chosen is Lakshem Corporate Berhad and also Petronas Group Berhad. So compared to that, current ratio for Lakshem is 3.85 and for Petronas is 1.68, which is Lakshem is more better. The reason is a higher current ratio show a stronger ability to meet a short-term obligation. So Lakshem is well above the ideal range, which is 1.5 to 2, indicating a very strong liquidity. So compared to current ratio, which is also included in a liquidity ratio, is current quick ratio. So Lakshem have 3.10 and also Petronas Group have 1.31. So compared to that, two companies, Lakshem is more better. The reason is Lakshem has more liquid asset, which is to cover the current liability, making it financially safer in the short term. So overall, the conclusion in liquidity ratio which can get from the both company which we have been chosen, which is Lakshem Corporate Berhad and also Petronas Chemical Group Berhad, indicating a strong short-term position and also a better ability to pay current liability is Lakshem Corporate Berhad company. So next is based on asset management ratio. So between Lakshem and Petronas company, which is more better? So first of all is inventory turnover. So for PC, Petronas Chemical Group is 6.61 and Lakshem is negative 38.53. So compared to both this company, better is Petronas Chemical Group. The reason is a higher positive inventory turnover, show a efficient inventory management. So compared to that, Lakshem has a negative figure, which is indicated inefficiency of or losses for the year. So the next we are going to compare is days sales outstanding, DSO. So for Lakshem is 0.35 and for Petronas Chemical is 35.83. So compared to those two companies, Lakshem is more better because the reason is lower DSO means faster collection of receivable, which improve our cash flow of the company. So Lakshem is more better on that. And also the third one is fixed asset turnover. So compared to Lakshem and Petronas Chemical, Lakshem is 6.36 and the Petronas Chemical is 1.05. So compared to this both company, which I feel like more better is Lakshem, because the reason is Lakshem use its fixed assets more efficient to generate the sales. So that's why Lakshem have 6.36% of the better than Petronas company. So the last one is total asset turnover. So for Lakshem 0.97 and for Petronas Chemical Group is 0.51. Yeah, 0.51. So compared to this both company, Lakshem is having more better because higher total asset turnover, which will be indicate a better overall asset utilization. So compared to this analysis from the asset management ratio, Lakshem performs a better overall in asset utilization, efficiency, as fixed asset turnover, total asset turnover compared to Petronas Chemical Group. Berhad is better only in inventory management. The negative inventory turnover in the Lakshem is a majority weakness and needed attention. So Lakshem has a better asset management efficiency overall, while Petronas Chemical Group perform better in inventory turnover only. So hence Lakshem is relatively stronger in asset management ratio.
Hi, my name is Nabi Ramadan. Next, I will present the peer analysis for the year 2024, comparing Lakshem Corporation Berhad with its industry peer. This comparison helps us evaluate Lakshem financial performance, risk position and market value compared to its competitor. Lakshem record a debt to total capital ratio of 11.69%, slightly higher than the peer at 10.88%. This indicates that Lakshem use marginally more debt financings. However, the overall gearing level remains low, suggesting minimal financial risk. Okay, so Lakshem's times interest earn ratio is 29.74 times, which is significantly higher than the peers 7.91 times. This shows that Lakshem has a very strong ability to meet its interest obligations, indicating low exposure to interest rate risk. Okay, then Lakshem achieved an operating margin of 10.37%, outperforming the peer 6.71%. This reflects better operational efficiency and stronger cost control compared to its competitor. Okay, next, the net profit margin for Lakshem stood at 7.42%, which is higher than the peers 4.20%. This indicates that Lakshem is more efficient in converting sale into net profit. Okay, in terms of asset efficiency, Lakshem record a return of asset of 7.18% compared to only 2.15% for the peer. This shows that Lakshem utilizes its asset more effectively to generate profits. Okay, for in terms of return on equity, Lakshem return on equity was 10.46%, significantly higher than their peers 3.34%. This indicates stronger shareholder value creation and more effective management performance. Okay, for in terms of basic earning power, Lakshem reported a basic earning power of 10.04% compared to the peer 3.25%. This highlights Lakshem's stronger operating earning capacity, independent of financing and tax structure. Okay, in terms of market valuation, Lakshem price to earning ratio is 11.25 times, much lower than the peer 35.20 times. This suggests that Lakshem may be undervalued of prices more conservatively by the market. In terms of market to book value, Lakshem market to book ratio is 0.96 times, slightly below book value, while the peer stands at 1.07 times. This indicates that Lakshem is trading at a more conservative market valuation. Okay, so in conclusion, Lakshem demonstrates stronger profitability, higher return and superior interest coverage compared to its peer in the year 2024. Despite having slightly higher leverage, LuckScam maintains a low overall risk profile and shows solid financial strength.
Assalamualaikum and hello, my name is Nadia Nohamidi. Today I will present the peer analysis using the 2-point equation followed by recommendation for LuckChamps and PChamp and the conclusion. Based on the 2-point results for 2024, LuckChamps recorded a higher ROE of 8.51% compared to PChamp's 2.9%. LuckChamp performs better mainly due to its stronger profit margins and more efficient asset utilization, while PChamp's lower ROE is influenced by weaker earnings and its capital-intensive business model, which limit asset turnover even with moderate leverage. Overall, LuckChamp shows stronger efficiency and profitability, while PChamp remains stronger in scale, market position, and financial strength. Therefore, PChamp is selected as the benchmarking leader, while LuckChamp is a strong mid-sized performer with improving fundamentals. Next, I will move to the recommendation and conclusion. Next, this slide presents the recommendation for LuckChamps in 2024 based on the ratio analysis and peer comparison with PChamp. Overall, LuckChamp performs strongly in 2024, especially in liquidity, profitability, asset efficiency, and financing safety. But there are key areas that must be managed to sustain these advantages. First, fixed working capital, especially DSO. LuckChamp's DSO is around 69 days slower than PChamp 56 days, meaning cash collection is slower. LuckChamp should strengthen credit control, set clearer payment terms, and improve collection monitoring. Second, protect margins by tightening cost control in procurement and logistics, and focusing more on higher margins product. Third, control inventory through better demand planning and reducing slow-moving stock, so working capital stay efficient. Fourth, invest for productivity to sustain strong asset efficiency, focusing on upgrades that improve plant utilization and distribution. Fifth, keep financing conservative. LuckChamp is already low risk, so debt should only be used moderately for clear returns project. And lastly, improve the valuation narrative by communicating better on DSO reduction, margin discipline, and capital allocation to build investor confidence. Overall, these recommendations are focused on helping LuckChamps protect its strengths while addressing its main weaknesses, which is receivable and cash conversion efficiency. Next, this slide presents the recommendation for PChamp in 2024 based on the ratio analysis and comparison with LuckChamp. Overall, PChamps remain the industry leader in terms of scales and market position, and its key strength is its fast receivable collection. However, the 2024 ratio shows that PChamp is held back by weaker liquidity, lower profitability, lower asset efficiency compared to LuckChamp. So, the recommendation for PChamp focus on the improving operational strengths while protecting its existing advantages. First, PChamp should boost liquidity by improving working capital planning and keep a stronger short-term buffer. Second, it should lift margin through a better cost control and stronger product mix. Third, PChamps need to improve asset utilization by increasing plant efficiency and reducing operational bottlenecks. At the same time, PChamp must maintain its fast collection because this supports cash flow. It also manages leverage carefully since debt is higher and interest coverage is lower compared to LuckChamp. Finally, since PChamp trades a premium valuation, it must deliver stronger operating performance to sustain investor confidence. In a summary, PChamp should continue leveraging its strength, cash collection discipline, while improving liquidity, profitability, and asset utilization to close the performance gap with LuxChem. To conclude, the 2024 ratio analysis showed that LuxChem is stronger overall performer, leading PChem in liquidity, profitability, and asset efficiency, which gives it better resilience in a cyclical market. LuxChem's ROE is mainly driven by the strong operation and efficient asset use, not high debt, and making its performance more sustainable. However, LuxChem must prioritize its weaknesses, which is rising DSO around 69 days, because slower collections can weaken cash flow. For PChem, liquidity is tighter and returns are weaker due to lower margins and asset turnover. But it has a strength in faster receivable collection around 56 days. Overall, LuxChem should improve working capital, while PChem should lift margin and asset productivity to improve returns. Thank you.